Is it finally time to take the leap and start investing in the stock market? Within the United States, we have 5,400 companies that are listed on the exchanges. Even a couple of those are broken into indices, such as the NASDAQ Composite or the Dow Jones Industrial Average. Now, when we look at today's video, we're going to be breaking down the S&P 500, which I personally invest in a multitude of portfolios because it is widely considered the best benchmark for the overall US stock market, looking at both the scope and the diversity of it itself. And we're going to be looking at the last 15 years of returns, what we're expecting in 2025, and also looking at the future of the market itself. So when we think of that S&P 500, it has returned 434%, excluding dividends in the last 15 years. Think about that, 434% in the last 15 years. That equates to 11.8% annually. Incredibly difficult to beat the S&P 500. That is the reason why famous investors like Warren Buffett say that everyone, including you and I, should own the S&P 500. When we start looking at this, the 1926 Standard Statistics Company developed the stock market index. That was the beginning. So we're talking almost 100 years ago that we have seen this. And then, of course, we know in March of 1957, that is when the S&P 500 itself was born. At the point, that's exactly what it became into, is the S&P 500. Now, this ETF tracks the 500 largest companies within the United States, which again, we're going to break down a little bit further. Now, to go in here, there are some general rules such as the GAAP, or the Generally Accepted Accounting Principles, profitability in the most recent quarters, and a minimum stock value of $20.5 billion liquidity within the stock itself. So there are some really good guidelines. Now, some companies do get delisted on the global exchange on the S&P 500, and also companies can join it. Recently, and really the most recent, which is huge, Coinbase Global joined the S&P 500 on May 19th, and really breaking into there means that the S&P 500 itself has to go ahead and pick up the stock. Now, because of this, we know that Capital One had the acquisition or acquired Discover. So Discover was delisted from that S&P 500, giving that slot for Coinbase to actually join. When we start talking about the market, and again, that S&P 500 fund, the 10 largest holdings are Microsoft, Nvidia, Apple, Amazon. We have Alphabet in there, Meta, Broadcom, Tesla, Berkshire, not Brookshire, Hathaway, and JP Morgan Chase. But when we start looking, remember the number we were talking about excluded dividends. Now, when we exclude the dividends, like I said, 434%. But what happens when we include those dividends? That takes our 434 to a whopping 609% return over the last 15 years, which is kind of crazy, looking at 13.9% annually if you had those dividends reinvested. So again, when you think about the possibility to beat out the market, you're going to have the last 15 years of a 14% annual return to actually beat the S&P 500 itself, which is kind of crazy. Now, also during that time, thinking of like COVID-19, looking at everything that has happened in the last 15 years, it's kind of incredible to see, a really broad range of economics that have went in, market environments, different presidents, and it is very plausible within the next 15 years, we could see that same 600%, or a lot of people are actually forecasting that we're going to see the S&P 500 up even a lot more than that 600%, really driven by AI, driven by quantum computing, driven by all of the artificial intelligence, and of course, the technology that is going around. Now, what does Wall Street expect from, and really the rest of 2025? As we've seen since Liberation Day, President Donald Trump was elected in November, the market kind of has pivoted kind of back and forth. But as of right now, we are still positive on the year itself. The benchmark has recouped all of those losses. Corporate earnings were incredibly strong in the first quarter, and it seems like they're going to be strong in the second quarter. The economy has been incredibly resilient so far, despite the tariff hikes, and the S&P 500 has done incredibly well. So thinking about a forecast of what we're looking at, and I want to break down some of these big firms. So remember, the S&P 500 is about 6,000 when it comes to the indexy. Wells Fargo is saying we're going to see north of 7,000 this year, implying a 17% upside for the S&P 500, which is kind of crazy. Morgan Stanley coming in at 6,500, UBS, Citibank 6,400 and 6,300 respectively. Goldman Sachs around 61. And a couple of these like Oppenheimer, RBC Capital, Bank of America are thinking 56 to 5,900, which right now we are sitting about 6,000, which of course, if they are, and if the forecast does come true, that means that S&P 500 is going to kind of remain flat for the rest of the year. But when you start looking at the 17 largest companies that are kind of forecasting with Wall Street investment banks, research organizations, looking at the upside and the downside, they are saying 2 to 3% growth is the median that we have between all of these companies that are really doing the forecasting. Now, when we start breaking it down a little bit further, S&P 500 at the end of last year, they were thinking 6,100. Now it seems like they're forecasting around 6,000 to 6,200. So again, right around that 1 or 2% growth. But starting to look at the downward revision of the earnings, this is interesting. So they're thinking Q2 of 2025 that we're going to see a 5.7% earning growth, which is down from 12%. So it is pulling back a little bit. This is due to the tariffs and everything that is going on with the Trump administration. That's also the reason why Jerome Powell in the Federal Reserve has not lowered interest rates. It's going to be interesting to see exactly what it's going to do. Now, Q3 of 2025, they're looking at 5.8% with the growth earnings revised down from 13, and then Q4 6.1 with a downward revision of 17.3%, which is kind of crazy. That's a pretty big one. So when we start thinking about the stock market, it is in a very interesting position as it sits today. White House imposing the tariffs on there. With the White House imposing tariffs on there, many economists expect the prices to increase and the economic growth to literally slow down, but that could also be counterintuitive or counteracted by releasing or lowering the Fed fund prime rate. Investors think, and looking at the index itself, seeing if we're staying kind of stable this year and having that return of 11.8% annually, just as it sees over the last 15 years, even looking at recession, looking at 2 bear markets, it is always a good time. This is the reason why I do dollar cost averaging, or DCA. What dollar cost averaging is, when you build out your budget, when you know exactly how much you want to invest on a weekly basis, a bi-weekly basis, a monthly basis, whatever it is, you invest on that time period. Let's say you want to put $100 into the market every 2 weeks. You want to invest into the S&P 500 every 2 weeks. You put that money in the S&P 500. If the market's up, you put your $100 in. If the market is down, you put your $100 in. That is dollar cost averaging. You are investing a set amount of money on a specific time frame, regardless of the market conditions, regardless of what the market is doing, and you can enjoy that 11.8% average return that we've seen within the S&P 500. So I always get the question, when should I invest? What does it look like? When is the best time? Honestly, like Warren Buffett always says, that's really impossible to time the market, but it is really about time in the market. When we start thinking of wealth generation, when you look at the psychology of money, it is investing over a regular time for an extended amount of duration. So if you're putting money in the S&P 500 on a regular basis, if you're putting it over, your 20, 30, 40, 50 years of investing, you are going to retire a multimillionaire looking at your investment strategy through dollar cost averaging. So that's going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.